The 2024 budget just came out last week, and largely most people's reactions were boring, with some parts leaving people going,
What?
Now the whole thing is very bulky and convoluted, so what I have done is gone through everything, and for this week's video I'm going to break them down into layman terms and only show you the things that I think will affect you going forward. There are clear winners and losers with this budget update, so make sure you go through the whole video so you understand how are you affected. Now before we start, if you haven't already, make sure you like this video, that's the best way to help us, and also join our private Facebook group where you can ask more questions and get more contents. Alright, without further ado, let's dive into this week's video. So I've segmented the changes into personal affected or corporation affected, and I'm going to start with the personal side first. And for first one, let's start with the smokers, because smoke and vape are about to get a lot more expensive. So starting Wednesday, tobacco duties will be $5.49 per carton. Now the budget also proposed vaping duty rates increase by 12% starting July 1st. So this is an extra 12 to 24 cents per pot, depending where you live. Maybe if you're smoking right now, first of all, it's really bad for you. Second of all, it's going to be very expensive on your insurance going forward. So maybe now is a good incentive to stop. Now moving on, let's talk about the second change, and this is more room to use for RSP home buyers plan. So the government is going to now increase the RSP home buyer plans from the $35K maximum per person to $60K. Now one thing to remember that you may be still able to use this even if you have a property already, because to be a first time home buyers, you have to not live in a place that you own for the last 4 years. So if you're someone that, for some of my clients who bought rental properties but stay living with parents or stay renting, you're still a first time home buyer, and if you haven't tapped into your home buyer's plan yet, you can still do so. Now normally with the home buyer plan, starting the second year since you have withdrawn from it, you have to start paying back over the next 15 years. If you don't do that, that year's payment will become your income and you pay tax on it. So other than the $60K change, they also propose to change the repayment start date from 2 years to 5 years. Now I'm guessing they're doing this because they understand that with $60K paying over the 15 years, that's $4,000 per person you have to start paying back starting year 2 if this was not changed. And that could be very hefty, very expensive for new homeowners. So this is why they're extending the grace period to 5 years to give you more time to work on your budget, to save up so you can do that repayment. So with this in combination with the new FHSA room, which is $8,000 per year, it's going to be fairly easy for a couple to come up with about $150K of down payment to even $200K, depending on when you're buying and what is the growth inside your RSP account. So this is great if you're a first-time home buyer trying to squeeze more down payments out of your accounts. However, I see this to have a massive upward pressure on some of the homes that are suitable for first-time home buyers, for example, 1 or 2 bedroom condos, and maybe even 3 bedrooms. So it's going to be interesting to see how this might affect those markets for the next 5 years. Alright, so the next big change is affecting the disability side. And here they are expanding the list of things you can write off to help your disability. So they added more to the category. These are things such as ergonomic chairs, bed positioning device, GPS for low vision, etc. The list is quite extensive. And also, if anyone using a service animal right now with the new budget change, you can either deduct the cost as a direct deduction or as a medical tax credit. So depending on your income situation, one could yield you more than the other. This is something that you probably have to talk with a CPA or planner to figure out which is the best way going forward. Now, other than the list expansion, the government is also introducing more income for the low-income disabled individuals. So this is confirming the Disability Benefit Act the Parliament has passed last year, promising to deliver benefit directly to low-income working age people with disabilities. Advocates previously is pushing for $1,000 per month for these group of people. They are going to be very disappointed to learn that this is only going to be $200 per month. But anyway, free money is free money, even though I also agree that $200 per month is pretty low, especially if you're in Vancouver and Toronto. That's pretty much nothing. However, I guess it's still good. Now, moving forward, fifth change is much higher penalties from CRA for non-compliance. So with this new budget change, if CRA requests info from you and you do not comply, they're going to issue a non-compliance notice to you. With this notice, this is going to cost you $50 per day to a maximum of $25,000 until you comply with them. And if it's a court issue notice, which is one step beyond the non-compliance, and you don't comply with that, that's an additional 10% penalty on all the tax payable for the year. For the 10% court penalty to be in effect, your tax owing has to be $50K or above. All right, the last and final, and probably this is one of the biggest change, is the change in the capital gain inclusion rate. This is going to come in effect June 2024. Individuals will now have a tier system when it comes to capital gain. For the first 250K, it will stay as the old system with a 50% inclusion rate. Anything over the 250K, it will now have a 2/3 inclusion rate. So if you're someone that earned 500K capital gain for that year, maybe from selling stocks or property, then under the old rule, 500K times 50% inclusion, that's 250K of taxable capital gain to add on income. Assuming you're a very high tax earner at the 50% tax bracket already, your tax will be 125K under the old system. With the new system, the first 250K will have a 50% inclusion rate, so that's 125K. Plus the next 250K will have a 2/3 inclusion rate. Together, we're going to have 291,000 of taxable cap gain. Times your 50% tax bracket, that's about 145,000 in tax. And this is roughly a 4% more tax. Now, this doesn't seem like a big deal with this example, but the higher we go with the cap gain for that year, you can see on the list compared to the old system, the tax does get quite a bit very quickly. Now, one effect that people also don't think about is with this tier system, it is also going to affect someone that dies. So you may not be triggering 250K capital gain throughout your lifetime, but if you have some rental properties or some non-reg investment, when you die, it's actually over 250K cap gain, and that might hit you quite heavily. So again, this is where estate planning, tax planning is going to be very, very crucial. However, the main issue I have with this is not with this tier system. I do believe this is okay. Not many people have 250K worth of capital gain for a single year anyway, and not for a prolonged amount of time. So I don't feel like this is a big issue. My issue with this tier system is what happens when we bring it to the corporate side. So with personal side done, let's jump over to the corporate side, and we're going to start with the capital gain inclusion first. Now, the corporate side, what's going on is that there is no tier system. Right away, you get hit with a 2/3 inclusion rate. This is going to create quite a bit of tax difference for any capital gain up to the 250K mark. Now, the chart shows a breakdown of what the tax will do when you invest in a corp versus distributing yourself under the old rule and the new rule. Under the new rule, you can see that for anything under 250K, the cap gain difference is at 10% if you compare personal to corporate. Basically, you're paying 10% more tax just because you decide to allocate your investment in a corporation versus individual. This will destroy integration, which is inside a tax system. CRA is trying to position themselves in a way where it doesn't really matter if you do things through a corp or personally, because at the end of the day, once you pay out all the money and we calculate all the tax, you're about the same no matter which way you choose. But with this, the integration up to 250K cap gain doesn't exist anymore. You're actually much better off doing it personally than inside a corp. I think the government is massively underestimating the amount of impact this will have on all small businesses just trying to invest their reserve for a couple years, maybe for expansion down the road. Now, I believe a much better solution is to give the 250K tier system to be shared between personal and corporate. So everybody gets only 250K. It doesn't matter how you allocate personal or corporate, it's all the same. This will maintain tax integration and not penalize small businesses just trying to invest a little bit of reserve for the future operation. This is for sure going to incentivize people to sell most of their assets by May just to get that 50% inclusion rate and reset their ACB to a higher mark. Now, another effect is for anyone trying to become non-resident, this is going to push people to exit Canada quicker to make sure they don't get hit with that 2/3 inclusion. And finally, one comment is that while I do understand why the idea of taxing wealthy people is popular, I see where people are coming from. One unintended consequence with this tier system, especially inside the corp with no tier, is investors right now will have much less incentive to pour the money into projects for building like rental units. So this might actually be counterproductive to the housing crisis we're going through right now. But whether this will actually move the needle, this is something we'll have to see going forward. Now, staying with the same direction of capital gain, the next big change is more lifetime capital gain exemption for business owners. Now, currently, when people sell their businesses or voting shares and they claim the lifetime capital gain exemption, they can save around 250K in taxes. Budget 2024 proposed to increase the exemption amount to 1.25 mil starting June 25th, 2024. This change means that individual could now save around 416,000 in tax on qualifying sales. And people that have used family trust to spread their tax is going to enjoy even bigger tax saving. Now, people need to discuss with CPA or planner in detail to decide if they are selling their business, do they want to do it before June or after? Because with the new cap gain inclusion, with the lifetime capital gain exemption, with the next change we're about to talk about, it can provide significant tax differences. So next, let's talk about the third big change, and this is the Canadian Entrepreneur Incentives. So this is a new thing they have introduced this year. Basically, they're trying to entice more people to start their business because they're going to get even better tax break going forward. Starting 2025 January, there will be a qualifying cap gain, which will give you a 1/3 inclusion rate instead of the 2/3 we just mentioned. But there is a cap to how much cap gain you can deem as qualifying. This is like a TFSA room. You accumulate this the moment you start your business. It is 200,000 room per year, up to $2 million max. This may not be much tax saving upfront, but over time, it can provide quite a bit of tax differences. Now, combined with the new cap gain inclusion and the bigger lifetime capital gain exemption, this can give you better tax break depending when are you selling your business and for how much you're selling it for. Usually, the sweet spot is probably around 2030. Anything after that, you're very likely going to get a much better tax break versus the old system. I've included a link in the description below. This is a Excel made by Jason Watt on LinkedIn. It is a very simple calculator that lets you input different dates of sale and for different prices to give you a rough idea if you are better off or worse off with this new change. Alright, so the fourth change is the Employee Ownership Trust. This is made to encourage business owners to transfer their business to an employee-owned model. Now, this was introduced in 2023, but it was very, very lackluster. There's not much interest in it. So for 2024, they've sweetened the pot by giving you a $10 million exemption to cap gain if you go through this trust to make a sale to your employees. I'm not going to go too much into this because despite the fact they've sweetened the deal, I see very little people being able or have incentive to take advantage of this trust. And this is because it is very restrictive to qualify, and also it adds quite a bit of liabilities onto the owner of the business to do these kind of sales. So at the moment, I don't see many people using it. Alright, so the fifth big change is a change to the Alternative Minimum Tax, AMT. Now, AMT exists so you can't just use things like donation to completely offset your tax for that year. There has to be a minimal amount of tax that you have to pay, even if you made a huge donation. Now, initially, many tax credit only are going to have a 50% inclusion rate when it comes to AMT, and this brings a lot of concern, especially by using donation tax credits. Budget 2024 proposed to allow 80% of donation tax credit to be included for AMT purpose instead, improving the situation for taxpayers, but it's still going to be quite challenging for people with substantial capital gains. The screenshot shows a comparison for someone with very large cap gains using donation to offset this. Now, as we can see, 2023 AMT change makes donation a lot less effective. 2024 somewhat relieved this burden, but it's still quite costly to donate. And on top of that, there are the following changes to the AMT in 2024. Overall, this is only going to affect people with cap gain over 250K and trying to tax plan using donation. Now, this combined with the tier system in the cap gain makes the whole thing very convoluted. So if you're going to use donation to offset cap gains, make sure you're working with a CPA on this. Alright, second last change is accelerated depreciation for some assets. So with this new budget, they're going to give you much higher depreciation for certain tech-related assets and purpose-built rental buildings. Productivity enhancing assets such as patents, data network infrastructure equipment, or electronic data processing equipment will qualify for immediate 100% expensing instead of the typical CCA rate. Now, to qualify for this depreciation schedule, the asset has to be acquired on or after April 16, 2024 and available to use by end of 2026. Now, purpose-built rental projects that started after 16 of April 2024 may qualify for increased CCA on Class 1 buildings from the 4% going up to the 10%. Now, there are requirements, for example, number of rental units you're building, so this is something you probably have to check out and research with a CPA. I feel like this is okay. The tech side is neat, it's interesting, but for the building side, because of how high interest cost is right now, they probably don't get to use this depreciation until a few years later. Alright, so the final big change is carbon tax rebate for corporations. Now, previously, only individuals get this. Now, the private Canadian corp will get this refund as well. To get this, you have to have at least one employee, and you cannot have more than 499 employees in there. You don't need to apply for this. If you qualify, then you qualify. So this is good as well. This is yay, but in my opinion, I think the easier thing is just to scrap carbon tax altogether. I don't see this to be productive. There are articles out there saying that this is costing much more than what government is collecting through the tax. So it's a little bit counterproductive. But anyway, at least we get something for private companies. So this is it for 2024 budget. These are all the things I believe individual or corporate owners need to know. Now, if you see anything that applies to you or you think it affects you, let me know in the comment down below. Let me know also if it affects your investment decision or your business or personal side moving forward. Now, if you like these kind of videos, I do try to upload them every 2 weeks, so make sure you like this video, subscribe to the channel, click the bell button to get all the notifications in the future. This is Jacky. I hope you found this interesting. I'll see you in the next video. Bye!